Central banks around the world are considering launching digital currencies. They want to move with the future of payments and offer citizens more choice. But are they also a means to keep some level of control over the monetary system?
At the moment, the cash system is under serious pressure, so that form of central bank money is getting less and less. That's kind of a big existential reason at one end of the spectrum.
Think of it as digital cash, an entirely online version of the centralised physical money currently issued by central banks. Right now, 134 countries, representing 98% of global GDP, are exploring the idea of a CBDC, central bank digital currency. It already exists in the Bahamas, Jamaica and Nigeria, with a large-scale pilot underway in China. The intent, at least in New Zealand, is to provide an accessible alternate payment system, a move with the times where cash isn't as widely used and bank branches are harder to come by. But like with any new technology, there are questions to do with privacy and financial stability if it alters the use case for intermediaries and depositories, such as commercial banks. It's not a completely foreign concept. The dollars in our bank accounts already show as numbers on a screen, and when central banks print money, they do it digitally. It's not intended to fully replace physical banknotes and coins, and that's where concern may arise. Cash in circulation can be tracked to some degree, but is typically transacted anonymously. So if we shift to a fully digital monetary system, could central banks have the keys to oversee and even intervene in our spending? The US Senate just passed a bill called the CBDC Anti-Surveillance Act, ensuring that can't happen there. In this interview, I ask a Reserve Bank of New Zealand official about the process underway to adopt it here, including its use case and any safeguards. Hi Ian, thank you so much for your time. I appreciate it.
You're welcome. Nice to be here.
I want to go into the use case, the benefits, and the whole process to potentially adopt a CBDC here. But I think the best place to start is just why? So why is the Reserve Bank considering adopting a digital currency, and what issues could it potentially solve?
Yeah, so there's a few reasons why we're looking at it. One of the things is it's really important to think about the role of central bank money. Now, at the moment, most people, the way they access central bank money is cash, banknotes and coins. But central bank money plays a really important role in the economy. It's a unit of account. It's a store of value as well. It enables us to operate monetary policy to make sure that the interest rates are appropriate for economic settings. At the moment, the cash system is under serious pressure, so that form of central bank money is getting less and less. At the same time, digitalisation is growing rapidly, here and around the world. So this starts to raise some quite big questions around what we call monetary sovereignty. Right, so that's kind of a big existential reason at one end of the spectrum, but then there are other drivers for us. One of the drivers is we look at the New Zealand payment system and think it's not as efficient or innovative or competitive as it could be. That means that New Zealanders pay a little bit more for their payment services than they could in a more competitive environment. And we actually think that a central bank currency, or what we're calling digital cash, can have a bit of an impact there, can be a real spur to competition. So that's another driver. We care about people being able to access central bank money, and there is a financial inclusion dimension to this as well. Not everyone does have access to a bank account. At the moment, about 6% of New Zealanders are wholly reliant on the cash system, but it's getting harder and harder for them to access cash. Now, when we talk about digital currency, one thing we're always at pains to say is this is not about replacing cash, because people care quite deeply about it. It's about making sure people have choice in how they transact. So there are quite a few drivers for us to be thinking about this.
I want to jump in on your existential factor there. This could seem like, from the outside looking in, and as you sort of alluded to there, that the Reserve Bank is, through potentially introducing a CBDC, trying to give CPR to the monetary system that you control and the tools that you have. Is this all a means to continue central bank relevance?
Absolutely. When you look at central bank digital currency, this is something that all central banks around the world are looking at, and have quite active research programs. The concept of having a digital form of central bank money has been around for about 20 years. But it wasn't really until you got some big tech players starting to talk about global currencies like Facebook's Libra and then DM that the big the sort of the G5 central banks started getting really serious about thinking about what does this mean. And so it is important to be able to maintain monetary sovereignty. It is, we talk about the ability to operate monetary policy and set interest rates, but there are also some real efficiency benefits anyway. This unit of account sounds like economics 101, what you'd read in a textbook, and it kind of is. But it, if you imagine a world where central banks sort of disappeared and you had money was replaced by a whole bunch of stable coins. They're all called different units, or even the same unit, but they're actually worth something sort of different. This is getting back to the pre-central bank kind of era. So I don't want to sound too dramatic. This is not happening overnight, but it takes a long time when you're thinking about these sorts of changes in a monetary system. It takes a lot of planning, takes a lot of work. So we need to be thinking about it now.
So this is a matter of survivability for the Reserve Bank and central banks the world over, to put it not lightly, right?
Yeah, well, sovereign states tend to have sovereign currencies, or they group together like the euro area. But those currencies are meaningful, play an important role, and matter. So yes, and even if you don't engage with central bank money directly, one thing that I always say is you think about what happens, how you engage with money, right? Or anyone engages with money. Your salary goes into your bank account. You might use Apple Pay or EFTPOS or whatever to transact, and you might never touch cash, right? And people think, well, that I have New Zealand dollars in my bank account. Well, they don't. What they have is an electronic claim on a private institution. Now, what happens when there is uncertainty in an economy or some concerns about your financial institution or what have you? The first thing people do, they go to the bank and they say, I want cash. Because even if they don't think about it in these terms, even if they don't think about relative credit risk, intuitively they understand it. And so there's that dimension that central bank money brings as well. It's the safest form of money. So that there are all sorts of reasons why central bank money matters that people don't think about. And you could think of us as responding to some external drivers, but you can also think about us making sure that New Zealanders continue to have choice in how they transact.
Are there also other factors at play, like the Reserve Bank doesn't believe that commercial banks are serving consumers well enough, or to stop money from going to those big fintechs like you spoke about with Meta, or other financial apps like Wise and Revolut that we have here now? Or is it to try and keep a hold on centralised currency, to stop people from moving to these other forms that you talk about, decentralised currencies like Bitcoin?
Yeah, well, we're not really trying to stop people doing anything in a sense, but there is two sort of key parts to it. We've talked quite a bit about the monetary sovereignty side, but actually one of the really big drivers for us is the innovation side as well. The New Zealand banking system, the most profitable banking system in the world, on many measures, years behind, if not decades behind other countries. I think we're the only OECD country that doesn't have a faster payment system, for example. Now, we see digital cash, CBDCs, as being a way to drive competition and efficiency. So you mentioned trying to keep people away from stablecoins. Well, actually, that's not really how we see things. When we talk about the digital cash, how it would work, one of the things that we always stress is that it could be via your bank. So you could log into your bank, your wallet, and you could choose between whichever private bank account you want, or digital cash, or it could be by a wallet provided by a third-party provider, which isn't a bank. And that's an important distinction that we're making there, unlike some other countries, because we're saying we think that will drive innovation, it will drive more efficient, lower cost outcomes for the benefit of all consumers. Whether or not you use digital cash, you'll benefit from it.
I do want to talk more about how this would actually work and how it could be programmed and structured, but still just on these factors here. If we do just focus on this shift to decentralized currency, by some, certainly not all, we know for a fact that investors are moving into Bitcoin. I've done stories showing that millions of dollars of investor money in New Zealand is flowing to Bitcoin ETFs, Bitcoin funds, and also directly to Bitcoin holdings. The people who are investing in that and purchasing it, holding it, or trading it, they tell me that they like it because it exists outside of the current monetary system, and that they have frankly lost trust or faith in the centralized currency and centralized banking system because of reasons like inflation, which we're all experiencing, which they see really as a forced level of theft. So what makes you think that if that shift is happening, people would want to use a CBDC at all?
Yeah, well, I think when you think about crypto, there's two main types, right? There's the Bitcoin investment type vehicle, instrument, whatever you want to call it. And that's not what we're really focused on. Now, as a central bank, of course, you're interested in, potentially from wealth effects and risks and vulnerabilities from a financial stability perspective. But from the money, the future of money work that I'm involved in, that's not particularly interesting to us. What's more interesting is the other part of crypto, which is the stable coins, where the attempt there is to make a blockchain-based form of money that can be used in everyday transactions. Now, I draw a real distinction between the points I was making earlier around, global fintechs spanning multiple countries, undermining sovereign currencies, as distinct from stablecoins in New Zealand, transacting in the New Zealand dollar, possibly backed by whatever, but one of the things that they could be backed by, and the most obvious thing for them to be backed by, would be a form of digital currency. So we're not against blockchain-based innovation. In fact, we think that's most likely where most of the innovation will come from. So our work program looks at not just how do we make the cash system resilient and available to people, how do we make central bank money available digitally through digital cash, but also how do you then start to think about private innovation and money so you've got a coherent system. So we've also been talking about our role for fintechs. We're not there's sort of a spectrum around the world of central banks, from really leaning into and embracing and wanting their countries to be crypto leaders, through to we don't like it, we're against it, we're regulating against it. We're not in that space. We see an ecosystem where fintechs have got to play a really important role. They'll provide a lot of the innovation, a lot of the niche products, and a lot of the competition. So there's a question there about how do you facilitate an environment where they're also trusted. So there are questions for down the track around regulation and how that works in a way, because money is ultimately all about trust and confidence.
You mentioned regulation there, and I wonder if this is also at all preparation for regulation on other digital assets like cryptocurrencies and Bitcoin, so that the CBDC would kind of be the one that everyone has to fall back on. Are you thinking about that?
Well, not in those terms, not in a competitive sense. What I mean is, if you look at so I've made this distinction already about investment type crypto and payment type crypto, and what we're interested in the payment type crypto. It's fair to say that those sort of cryptos, the stable coins, have not covered themselves in glory over the last several years. There's been claims made about backings that don't turn out to be true, all sorts of issues. So all we're talking about is providing, and we're not at the point where we're talking about specific regulation. We're talking conceptually at some point for people to have trust and confidence in New Zealand forms of stablecoin. And they're currently investing in them, using them. That's fine. But for broader uptake, and in due course, there's going to need to be some kind of regulatory floor. That is not to regulate who uses what or to try and push people to central bank digital currency. On many levels, it doesn't matter to us who uses or how much people use digital cash versus physical cash versus private money. We're interested in choice and good outcomes for New Zealanders, not trying to compete with the banks or the fintechs. That's not the game that we're in.
I know that you're calling it digital cash, but it actually is a Reserve Bank of New Zealand issued government-backed New Zealand dollar stablecoin.
Well, that's a very good analogy. It's exactly what it would be. I mean, but stable coins tend to, they're backed by something else. The digital dollar is a claim on the central bank and therefore, the government, just like cash is. So it's just that's why we're calling it a digital cash. It's a digital form of cash in a way.
Let's go into how this would work. How would I use it and interact with it? How would I be able to access my money and spend it if my digital cash was held with you?
Yeah, so we at the moment we're consulting on some of the design features that it would have. So I just want to preface it by saying, there's still a lot of water to go under the bridge in terms of specifically how it would work. But conceptually, how it would work would be you would access it through a third party. So it would not be held by the Reserve Bank. And one of the things that comes up all the time is concern about, well, why would I use central bank money, a digital form of money? I don't want the government knowing what I'm spending my money on. Part of the point here is that the Reserve Bank gets no line of sight of the transactions. So you would access it through your bank, where you transfer money in your wallet provided by your bank between your transaction account into your digital cash account, or through another provider, a fintech or whoever. How you would use it would be you'd walk into a shop. It's a generally available form of digital cash. So you would walk into a shop, you would pay for something at the point of sale, just like you would pulling cash out of your wallet, using Apple Pay, using EFTPOS, using credit cards. It would just be one more choice for you. So there'd be no point of difference there. One of the main points of difference, of course, are the credit rating, right? Of the cash that you hold is a higher credit rating than the private sector. It will have some offline functionality, so you could use it when the internet's down or power's out. You could do peer-to-peer, and it would be instant. So there are some design features that make it different. But from a practical point of view, it's all about choice, and it wouldn't feel or look any different to you than how you're currently transacting.
The difference, though, I'm assuming would be in where the deposit is held one for one. So that deposit would be held by the Reserve Bank as opposed to with a commercial bank.
So you could think of it a bit like us as a wholesaler. Just as with the cash system at the moment, we get the coins minted, the banknotes printed, and then we send them out to a bank, and you access it and you hold it. In that sense, your money would be held with whatever third-party provider you chose to access digital cash through.
Then how would the credit rating be higher?
Well, because the claim, I'm talking about the facilitation of the wallet. The claim is on the Reserve Bank. That's right. So if you held, these are sort of finer points of detail to work through. But in terms of if you held money with a third-party provider, your claim is still on the Reserve Bank. So that's why the credit rating's higher.
Let's talk about those concerns. The Reserve Bank says in its own material about digital cash online that it would be safe and secure. And as you've said, that it would be backed by the Reserve Bank, so that's on you. But the Reserve Bank has been subject to a cyber attack in 2020, and in the year after that had a data breach. And even the big commercial banks can't keep us safe from fraud and scams. So how is this supposed to do it?
Yeah, so it's a good question, and scams and fraud and cyber is the topic of the day, and everyone's leaning into it. I mean, one of the things, so we're not at a point where we're actually building systems or designing. We're just simply making the point that trust is paramount, and it will need to be extraordinarily secure. No central bank. It's untenable for central banks to think about. There's just people losing confidence in their money. So I don't really have a technical answer for you at this point, other than to say that we won't be issuing digital cash until we are fully confident that it is as secure as it can possibly be. And that involves thinking not just about the current environment, but the future environment, quantum proof, and those sorts of things. So yeah, I mean, there's still quite a lot of water to go under the bridge until we basically start to set the standards and the benchmarks and those kinds of things. We're simply making the point that, they are extraordinarily important considerations.
So you're out there saying that it's going to be safe, secure, and private, but you can't actually be sure of that because you haven't programmed the thing yet. So is that a bit unfair to be selling it as that when it's really just a promise and not a fact?
I'm not sure we would argue that we're selling it. We're talking about a concept design here. So the first consultation we did is we said, hey, there's this thing called digital cash. What do you think about it? Now, for people to really engage on this, they need to have a sense of what it is and how it will work. So this current consultation, so it's 2024 now. In this current consultation, we say, here are the sorts of design features that we think it would have to put more flesh on the bones, to make it more concrete, so people go, okay, well, if that's what you're talking about, this is what it means to me. These are the features I like. These are the things that you're not talking about that I'd like to see. So they get a sense of it. Now we're talking about a 2030 target date for launch. So it's not like we've got a prospectus out there and we're saying invest in this thing. We're trying to corner the market. We're just saying here's how it would look and feel to give people a better idea so they can talk about it. And I think it's quite reasonable for a central bank to say that security of it is extraordinarily important. Now, how we get there, because it's 2024, by 2030, you would expect that the world would have moved into quantum proof cryptology, for example. There will be lots of developments in technology around near-field communications and how you actually do the offline. I mean, it's all technically possible now, but standards will get better and better and more robust. So I don't think it's unreasonable to say, as a concept, these are the sorts of features that we think it will have.
Noting that this is all very much conceptual and you haven't sort of programmed any of it yet, but privacy is certainly a concern that I'm sure you've even seen come through very strongly in the submissions so far. So I want to pose a few scenarios to you, and if you can please debunk them or tell me if they are potential risks. What if the Reserve Bank just decides one day, if there's a global currency crisis and a sharp devaluation in our dollar, that you say you just cannot take your digital cash out today? Is that possible?
Not possible, I don't think, in terms of the way that we're talking about it. So, the money isn't programmable. at our end. We're not going to put any constraints on it. Once it's gone to it's like cash, you know, is the analogy we keep coming back to. We want it to be as similar to cash. So no, I think debunk on that one.
But it's not exactly like cash, because when you print cash and it goes out into circulation, while there are tracking numbers on it, it's typically transacted between us anonymously. It's not like there's chips in it. Whereas when something's digital, you could actually track it. So what's to say that you couldn't oversee our spending and intervene? What's the safeguard there?
Well, because we won't have, you know, we won't be the ones that are providing the wallet, so we won't see the transactions. I mean, the analogy with cash is a good one, and in the sense that cash, you're right, cash is the only truly anonymous form, right? So what we're saying is this will be private, and by design, the Reserve Bank will not get to see how that money is being used. Now, that's a different thing from saying, even at the moment, you leave a digital footprint. At the moment, law enforcement can reach through when, you know, with court orders and all the rest of it. If there's grounds for concern, I wouldn't imagine that would be any different. But that's a different thing from saying we're programming the money, we're telling you how to use it, we're watching what you're doing. We're saying by design that will not happen. Now, people, we can say that over and over, and we put a paper out along with our consultation paper on privacy to talk about how we think about it and why it's so important. But there is a lot of concern out there around, you know, and conspiracy theories around what the government's doing. Currently, banks track, you know, and monitor transactions and look at things as well. So in that sense, the third-party provider, you know, we talk about having really good consumer digital rights and protections as part of the sort of contractual arrangements with the third-party providers that may or may not end up being higher than what you're agreeing to with your current bank. But these are things to work through.
There is a difference, though, between it being a commercial bank and the state, which, as you mentioned, has law enforcement. So would you agree it's a warranted concern if our money is going to be more closely linked to state than commercial provider?
Yeah, I can see the link that people make, and absolutely don't want to say it's not a warranted concern. But then I think it's incumbent on us to make sure people understand the protections and the mechanisms and the constraints, you know, and the sort of the social contract in a way. So yeah, I mean, still water to go under the bridge on how these things are actually implemented. But in many ways, you know, you can make the point about how important privacy is to you blue in the face. It's another form of trust and confidence, right? So this is why it's important to do privacy by design, to be very transparent about how we're thinking about this and to talk about, you know, how it will work in practice. But ultimately, it's people's choice, and that's the point we keep making. You don't have to use this.
Let's talk about the financial stability risk. You've spoken a bit about third parties. So would a CBDC circumvent banks completely? And if so, is that not a financial stability risk?
Yeah, so it could, at the margin, circumvent banks completely, in the sense that we've been very clear that the third-party providers need not be a bank. So by definition, that is the case. But you know, the analogy that I use is it's a bit like you've decided to have a party, right? And you worry about two things. You worry that no one comes to your party, or you worry that it gets on social media and you're swamped and you have to shut the party down. Now, when central banks talk about that, typically they talk about disintermediation. So it's a slightly more technical term than my party analogy, but it's the same thing. You worry, and this is what banks themselves worry about. this disintermediation, that people move their money out of the bank and into this product, and that affects their funding base. Now, at a conceptual level, sure. At a practical level, I think those concerns, we think those concerns are wildly overstated, because it's unlikely that most people will want to use CBDC as their main source of transacting. But in any case, part of the subsequent design work we need to do is to have the sort of checks and balance and design in constraints so that destabilizing defunding of banks cannot happen. This is not a play to take over private money. That's the last thing that we want to see, and the Reserve Bank is responsible for financial stability. But that's a different thing from saying, at the margin, more competition and money flowing into third-party providers that drives better competitive outcomes and some competitive tension into the system is a good thing. It's a scale question in many ways. So conceptually, sure, and that is one of the reasons why banks worry. Now, I don't think they worry about the Armageddon scenario. They don't worry about that, but they do worry closer to home. What does it mean for their bottom line, for profitability? We've been quite clear that we think the payment system in New Zealand could be more competitive and more efficient, and therefore that has some implications for banks, sure.
Well, it could, if it stole at least a portion of deposits from banks to third-party providers that may or may not be bank products, that then those banks have less money to lend. So while it looks like it would give us, or sound like it would give us consumers, more options on the face of it in terms of deposits, it could give us fewer options on lending.
So, well, firstly, I wouldn't say people choosing to put their money elsewhere is stealing money from the banks. It's a slightly loaded terminology. But secondly, if you're thinking about it from a fintech perspective, banks have scale. It's more likely that you'll see innovation being driven by fintechs partnering up with banks to provide functionality or wallets or what have you. But in any case, the arguments around competition need not be a win-lose type thing, and it need not mean that you only get this competition by the third party providing all the innovation. If you've got competition in the system, that should affect the overall level of pricing through competitive effects, even if everyone stayed within the banking system. Because if you're starting to see more product offerings across different banks, that's another form of competition, right? So I think there's sort of very black and white arguments that you hear. And I'm not suggesting that that's the point that you're making, but you do hear it quite often, that this is some kind of sky is falling type scenario. We're pretty skeptical of, because we can design in the kind of safeguards and the checks and balances, around how much money could you actually hold in your wallet, those kind of things. No one wants to see financial instability. That's not what we're talking about here.
I'm assuming you've already met with banks and that they probably provided submissions in this consultation process. Can you give me an early indication as to what they're saying?
Well, we've been having, I guess, a dialogue for a few years now, because we did our first consultation on central bank digital currency 2021, I think. And the kind of feedback that we get is, we're a bit nervous of this and we don't really like it. We're still in the midst of our second consultation, doesn't close until the 26th. There've been a few questions, clarifying questions from banks, but we're not at a point where I'm not even sure we've got their submissions in quite yet. So it's a bit too early in terms of what the banks are saying, but I think the general vibe that we've been talking about will be present in their submissions, I'm sure.
Is that a general positive vibe or a general negative vibe?
A nervous vibe. What if we at the RB said, well, we're not interested in any of this. We're not doing CBDCs. We don't care about stablecoin regulation. Then you're looking at a world of, volatility, real competition, and potentially not just local fintechs, but global fintechs coming in and potentially eating the bank's lunches. So, it's you need to keep in some perspective the role that a CBDC will have. We think as much as anything, it should be a welcome development. I think once the banks have thought through it enough, I'm quietly confident they'll get there. But at the moment, it's new, and when we talk about innovation and competition, of course, it can make the large incumbents especially a little bit nervous.
I'm sure you're aware in the US the passing of the CBDC Anti-Surveillance Act. It's kind of virtue signaling slightly because the Fed hasn't actually said that they'll do a CBDC like you, and if they did, they would probably need congressional approval anyway. But I'm interested in what the approval process could or would look like here. Would there be a referendum? Would the public get to vote and yay or nay it?
No, I wouldn't think we'd be going down that route. I mean, I think what we have said is, our ability to issue banknotes and coins is in our legislation. And there are concepts around legal tender, for example. And we currently actually issue a digital form of New Zealand currency and have done for decades as part of our ESAS accounts that we use to operate monetary policy. But having said that, so we're not saying that we can currently do this. What we're saying is we think the nature of this is something that it's going to involve lots and lots of public consultation, and it's almost certainly going to involve new legislation. So there will be a parliamentary process around support of this. It's not the sort of thing that the Reserve Bank will suddenly just start issuing by itself. And I think there will be a lot of debate. I don't know quite what the mechanism or the approach will be, but there will be a lot of debate about protections and surveillance and privacy and all those sorts of things, as there should be.
Well, I'm glad that it's starting here, Ian. I really do appreciate your time. I just wanted to end on one question. And it's one that is often asked of tech entrepreneurs who, through their products, especially like AI at the moment, want to capture more of our money and our economic output. So I'll ask you what Sam Altman has been asked before. Why should we trust you?
Why should you trust us? Well, as an institution, we've been issuing money that people have trust and confidence in since 1934. And we have a public policy purpose, and it's laid out in our act. And everything we do, whether it's thinking about the cash system, whether it's thinking about crypto, it's all grounded in meeting the needs of the New Zealand public. It's not grounded in a profit motive.
Thank you, Ian. It was nice to chat to you.
You're welcome. Nice to talk to you.
Thanks for watching Markets with Madison. If you enjoyed this interview, please hit the like and subscribe buttons below. I do all of the research for these episodes myself, so your support means a lot. I always love to hear your feedback and ideas, so please drop any thoughts in the comments below. Now go put your money to work.